So, let's talk about 2025. It was a really strange year in the financial world. You had stock markets around the globe doing pretty well, even soaring. But India's main index, the Nifty 50, it was going the other way. It was a genuine market mystery. And over the next few minutes, we're going to play detective, follow the clues, and figure out exactly what went wrong.
Okay, this slide just lays out the puzzle perfectly, right? On one side, you've got global markets putting up solid numbers. And on the other, you've got India's Nifty 50 taking a nosedive. This wasn't some global wave pulling everyone down. Nope. This was a uniquely Indian story. So what on earth was going on?
All right, our investigation starts with the prime suspect, the single biggest reason things were set up to fail. And to put it simply, the price of Indian stocks was just, well, it was way too high.
Now, to get our heads around this, we need a quick look at one little tool, the P/E ratio. And don't worry, it's not as complicated as it sounds. Just think of it like a price tag. It just compares a company's stock price to how much profit it's making. So a really high PE means you're paying a lot for every dollar of profit. It's probably expensive. A low PE means you're paying less. Could be a bargain. Simple as that.
And here's where it gets really interesting. This chart just shows you the problem so clearly. Just look at that bar for India. Its PE ratio was absolutely towering over other emerging markets, not to mention the global average. Investors were paying this massive premium to own Indian stocks, and that premium was getting harder and harder to justify.
So here's the crucial point. You can justify a high price tag if profits are absolutely exploding, but they weren't, not even close. The earnings from Indian companies just couldn't keep pace with the sky-high expectations that were built into those stock prices. The market was like a rubber band stretched way, way too tight, just waiting for something to make it snap back.
So that overvaluation, that made the market fragile, vulnerable. But just being vulnerable isn't enough to cause a crash. You need a push. So now, we need to find the accomplices, the factors that actually pulled the trigger and started the big money drain.
And it really came down to this brutal 1-2 punch. First, like we just said, profit growth started to slow down. And second, seeing this, the big global investors, the ones people call the smart money, they decided it was time to cash in their chips and get out.
And this slowdown wasn't in some tiny, obscure companies. It was hitting the absolute giants, the heavyweights that drive the Nifty 50. The IT sector got slammed when global clients cut their spending. Banks felt the squeeze on their profit margins. Consumer goods companies saw demand in rural areas just dry up. And the pharma industry? Intense price competition. When all your star players are having a bad day, the whole team is going to lose.
So you've got crazy high prices and slowing profits. What do you think the big international investment funds did? Yep, you guessed it. These guys, the foreign institutional investors, or FIIs, they saw the writing on the wall. After making a ton of money in India for years, they decided the party was over and it was time to take their profits and go home.
And we are not talking about a trickle of money here. The outflow in 2025 was a flood, one of the biggest we've seen in recent history. Just get a look at that number. Billions upon billions of dollars being yanked out of the market creates an incredible amount of downward pressure.
So what made them all leave at once? Well, it was kind of a perfect storm. Back in the US, super safe government bonds were suddenly offering better returns. The US dollar was also getting stronger, which shrinks the profits for a foreign investor when they convert their rupees back. You add that to their worries about India's high prices, and it was just a no-brainer to sell.
Okay, so right about now, you might be thinking, hold on a second. What about all the Indian investors? Weren't they pouring record amounts of money into the market? And that is an excellent question. Let's go investigate that alibi.
This is really the heart of the matter, isn't it? We all know that local Indian investors, especially through things like mutual funds, were investing more than ever. So why couldn't their money stop the bleeding? And this chart, this tells the whole story. The money from Indian retail investors wasn't going to the same places the foreign money was leaving. Look where that biggest slice of the pie went. It was flowing into mid-sized and smaller companies, what we call mid and small caps, where they thought the real future growth was hiding.
So the bottom line is, the domestic investors and the foreign investors were basically playing in different parts of the playground. While the foreigners were selling the giants, Indian investors were busy buying up the next generation of potential winners. The Indian money was definitely there, but it just wasn't big enough to fill the massive hole the FIIs left behind in the Nifty 50.
Finally, to really complete the picture, we have to zoom out.
Because all this drama wasn't happening in a vacuum. It was all taking place inside a wider, really challenging economic environment that created a perfect storm.
So this was the backdrop to our whole mystery. You had inflation that just would not quit, making everything more expensive. Government spending, which is a huge driver of the economy, was slowing down. Global oil prices were on the rise, putting a huge strain on the country. And on top of all that, a weaker rupee made things even less attractive for foreign investors. Any one of these is bad. All of them together, that's a recipe for a market slump.
And there you have it. You put all the clues together, and the mystery is solved. It's almost a simple equation. You start with a vulnerable, overpriced market. You add the trigger of slowing profits and a mass exodus of foreign money. You fan those flames with a tough economy, and you get the 2025 slump.
And that leaves us with the big, lingering question. Was this slump just a healthy correction, the market letting off some steam and getting back to reality before the next big run-up? Or was it a flashing red warning light of deeper, bigger problems for the economy down the road? That's the billion-dollar question that investors are still trying to answer. Thanks for digging into this with us.